Okay, let's unpack this. Today, we're embarking on a deep dive into the truly dynamic, and let's be honest, often bewildering world of financial markets and investment strategies.
It certainly keeps us on our toes.
Absolutely.
Mm.
If you've been wondering what's genuinely driving the biggest trends in the economy right now, or perhaps what's impacting your own investment portfolio, well, you are in exactly the right place.
We hope so.
Think of this as your personalized shortcut to being thoroughly well-informed. We're aiming to cut through the constant noise, get straight to the essential, actionable insights.
Absolutely. And our deep dive today is centered around a crucial, very fresh document, Market and Growth Stock Analysis, a strategic report for the modern investor, August 13th, 2025.
Right.
Our mission really is not just to summarize this thing, but to actually dissect the very latest market data and strategic insights. We want to help you, our listener, navigate the current investment landscape with hopefully greater clarity and confidence.
Yeah, confidence is key in this market.
It is. The ultimate goal here is to provide a nuanced understanding of why markets are behaving as they are right now, to pinpoint where the most compelling future growth truly lies, and to equip you with powerful, practical tools to analyze these opportunities for yourself.
And when we talk about what's unfolding right this moment, the immediate context is pretty hard to ignore.
It really is.
U.S. equity markets are continuing this powerful, sustained upward trend. They're building on a whole series of record-setting sessions. Investor sentiment, as we analyze it today, August 13th, is decidedly, almost exuberantly bullish.
Definitely bullish, yeah.
It's a fantastic, albeit sometimes maybe a bit disorienting, time to really understand the intricate mechanics going on beneath those exhilarating headlines.
Agreed. So much driving it.
Okay.
The current market landscape, riding the bullish wave.
So let's zoom in on that immediate snapshot, shall we? This report tells us that today, Wednesday, August 13, 2025, U.S. equity markets aren't just ticking up slightly.
No, far from it.
They're surging. And there's distinct leadership from technology and other growth-oriented sectors. We're seeing the S&P 500 up a healthy 0.7%.
Solid game.
The NASDAQ composite, our tech-heavy barometer, climbing an even more impressive 1.2%.
Leading the charge, as often happens.
And even the traditionally steadier Dow Jones Industrial Average is posting a respectable gain of 0.2%. It's a pretty green screen across the board.
It is. And what's truly fascinating here and really crucial for understanding the current momentum is that this isn't just some fleeting one-day pop.
Right. It feels more sustained.
Exactly. This robust performance actually extends a rally that saw both the S&P 500 and the NASDAQ composite close at all-time highs just yesterday, Tuesday, August 12th.
Yesterday was huge.
It was. To give you some specifics, the S&P 500 surged a substantial 1.1% yesterday to close at 6,445.76.
Wow.
And the NASDAQ jumped an even more significant 1.4%, hitting a new record of 21,681.90.
Incredible numbers.
And not to be left out, the Dow Jones Industrial Average also participated strongly. It climbed 1.1%, which, translates to a hefty 483 points, reaching 44,458.61.
That kind of broad-based participation, especially hitting records like that, it usually signals some real underlying strength, doesn't it?
It really does. It suggests it's not just one or two sectors carrying everything.
That's quite the run. But sometimes, when markets are this, ebullient, you wonder if there's a sense of irrational exuberance creeping in.
That's always the question in the back of your mind.
So what's the real mood indicator here? The report points to the CBOE Volatility Index, the VIX. People often call it the market's fear gauge.
The fear gauge, yeah.
Help us unpack that. What does a falling VIX truly tell us beyond just, less fear?
That's an excellent point, because the VIX is actually more than just a simple sentiment meter. It essentially measures the market's expectation of volatility for the S&P 500 over the next 30 days. And it's derived directly from the prices of S&P 500 options contracts. Think of it maybe like an insurance premium.
Ah, okay. Like insurance.
Yeah. When investors anticipate turbulent times ahead, they buy more options, usually put options, to protect their portfolios. That increased demand drives up option prices, and consequently, it pushes the VIX higher.
Makes sense.
So, conversely, when the VIX falls sharply, as it did by a really significant 9.4% down to 14.73 on Tuesday.
That's a big drop.
It's a big drop. It signals that investors are collectively expecting less market turbulence. It's a tangible manifestation of a significant decrease in perceived risk, indicating, pretty widespread confidence in the market's stability, at least in the near term.
So confidence is high domestically. But what about globally? For our listeners invested internationally, does this optimism truly extend beyond U.S. borders, or is Wall Street just kind of in its own little world sometimes?
Well, it's definitely not confined this time. If we connect this to the broader global picture, this optimism is proving pretty infectious. Global markets are broadly charging higher, and they're clearly taking their cue from Wall Street's record-setting performance.
Interesting. So where else are we seeing gains?
In Europe, for instance, we're seeing Germany's DAX up 0.8%. Paris's CAC 40 is gaining 0.4%. Even the FTSE 100 in the UK is up a modest but still positive 0.1%, standing at 9,157.26.
That's fascinating how Wall Street's performance can send such powerful ripples, right across the Atlantic. I'm curious, does this bullish sentiment extend even further east? Are we seeing similar robust activity in Asian markets? Or do they sometimes operate on a different rhythm, given their unique economic drivers?
No, Asian markets are absolutely mirroring this robust buying activity. It confirms the global synchronicity of this particular rally.
Okay.
Hong Kong's Hang Seng Index, for example, surged a notable 2.6% to 25,613.67.
Wow, 2.6.
Yeah, and Tokyo's benchmark Nikkei 225 added 1.3% to reach its own record level of 43,274.67. Even India's Sensex is participating, up 0.38% to 80,539.91.
So this widespread global pattern, it really underscores the significance of whatever underlying drivers are influencing investor behavior worldwide.
Exactly. It suggests a kind of shared fundamental optimism, not just localized excitement in one region.
This broad-based rally certainly feels powerful, but some might argue that in financial markets, things are rarely as straightforward as they appear on the surface.
That's usually a safe assumption.
Beyond the obvious headlines, what are some of the maybe less intuitive factors or perhaps even some hidden risks that are truly fueling this enthusiasm? Where should we really be focusing our attention when we dig into the why behind all this?
That's precisely the deep dive question we need to ask. The report makes it clear that the market's pronounced strength is deeply anchored in several key macroeconomic developments. And the primary catalyst, the absolute biggest one right now, is fresh inflation data that's completely reshaping expectations for central bank policy, specifically the Fed.
Right, the inflation numbers, always key.
Always. But the real nuance lies in how that data is being interpreted and what the downstream effects are.
So let's get into that core driver then. The U.S. Department of Labor's report on the Consumer Price Index, the CPI, for July, it indicated that headline inflation rose 2.7% on a year-over-year basis. Now, 2.7% doesn't immediately sound like a dramatic number.
Not on its own, no.
But the report stresses that it came in slightly below the 2.8% that economists had forecast. Why is that seemingly minor deviation, just 0.1%, so profoundly impactful? And what about core CPI? I think that came in a bit higher.
Yeah, you're right. The devil is truly in that decimal point.
Yeah.
The seemingly minor deviation is profound because it suggests that overall price pressures are moderating maybe a bit more than anticipated by the consensus. And while it's true, as you mentioned, that some underlying measures, specifically the core CPI, which strips out volatile food and energy prices, were slightly hotter at 3.1% versus a 3.0% forecast.
Right, so core was a bit hotter.
A tiny bit hotter, yeah. But the market's attention is overwhelmingly fixated on that headline number. Why? Because the headline CPI is often seen as the primary barometer the Federal Reserve uses to gauge overall price stability and thus its policy direction. It's kind of the psychological anchor for interest rate expectations.
Okay, so the market gloms on to the headline number.
Pretty much.
And here's where it gets really interesting, and this is where you, the listener, probably need to pay close attention. This slightly softer headline inflation data is having a massive impact on investor expectations about the Federal Reserve's next move.
Huge impact.
The market is interpreting this as giving the central bank the necessary leeway, as they say, to pivot toward a more dovish stance, meaning easier policy.
Exactly. The green light, potentially.
And what does that mean for you directly? Well, traders are dramatically increasing their bets on an interest rate cut at the Fed's upcoming September meeting. According to CME Group data, the probability of a 25 basis point rate cut surged from around 86% before the report,
Which was already high.
to over 94% afterwards. That's a huge shift in conviction in just a day.
It's a massive swing, and the implications of that shift are profoundly significant for markets. Lower interest rates act as a powerful stimulant for the economy, and crucially, for stock valuations.
How so? Explain that connection.
Well, lower rates reduce borrowing costs for businesses and consumers, right? Which in turn encourages investment, hiring, and spending. But for equities specifically, for stocks, lower rates dramatically increase the present value of future corporate earnings.
Ah, the discounting effect.
Exactly. Think of it like a discount rate applied to future cash flows. When the discount rate interest rates is lower, those future cash flows, which are often years or even decades away for many growth companies, become worth more today. This direct mathematical impact makes lower rates a powerful structural tailwind for stocks, particularly growth stocks, which rely so heavily on that long-term future earnings potential.
This dynamic, the report points out, creates what many on Wall Street are referring to as a Goldilocks scenario.
The Goldilocks economy, yeah, we hear that a lot.
The 2.7% inflation reading is seen as just right. It's not so high as to compel the Fed to maintain or increase rates to fight runaway prices, which would cool the economy.
Right, not too hot.
But at the same time, it's not so low as to signal a sharp economic contraction or even a deflationary spiral, which would also be bad.
And not too cold, just right.
This just right level of inflation provides the perfect justification, at least in the market's view, for the Fed to begin an easing cycle, cutting rates to support economic growth without triggering undue alarm about reigniting inflation down the line.
That's the narrative, absolutely.
But here's a crucial insight for you. While a Goldilocks scenario feels wonderful, history shows these periods can also breed complacency. They can potentially lead to overvaluation in certain sectors or even asset bubbles forming.
That's the inherent danger. It feels good, maybe too good.
The real deep dive question becomes, are there hidden risks beneath this seemingly perfect surface? What indicators should we be watching for that might signal a shift from just right to too hot or too cold? This narrative, this Goldilocks story, is in fact a central pillar supporting the current market optimism. That makes it imperative to understand its fragility as much as its strength.
That's a vital distinction, and it really speaks to the nuance of proper market analysis. It's not just about the good news. And beyond the immediate equity impact, we're also seeing these shifting rate expectations having immediate ripple effects across other asset classes as well.
Like what?
Well, the prospect of lower U.S. interest rates makes holding U.S. dollars less attractive relative to other currencies, right? Because the yield, the return you get on dollar-denominated assets, decreases.
Okay, so the dollar weakens.
Exactly. As a result, the U.S. dollar index is falling, hitting its lowest level in over a week. This dollar weakness, incidentally, provides a significant tailwind for U.S. multinational corporations.
How does that work?
Because their profits earned overseas in foreign currencies translate into more dollars when they bring them back home, boosting their reported earnings numbers.
Ah, a translation benefit. Got it.
Yep. And furthermore, a weaker dollar inherently increases the appeal of commodities priced in dollars, like oil or gold, because it makes them cheaper for foreign buyers to purchase.
So commodities should rise.
And true to form, we're seeing gold futures rising as investors seek out non-interest-bearing bullion as an attractive alternative in a lower-rate environment. It really demonstrates a clear, interconnected causal chain.
So softer inflation data,
Leads to altered Fed policy expectations,
which in turn weakens the dollar.
thereby boosting both equities and commodities. It's like a beautiful set of dominoes falling for investors right now.
It really lines up. And to add another layer of relief, almost like a psychological balm for the market's risk appetite, the report also highlights some positive developments on the international trade front.
Oh, yeah, the trade situation.
It notes that President Donald Trump's administration has extended a truce in the ongoing trade war with China, effectively pushing back the deadline for imposing new tariffs.
That's definitely helpful. Take some uncertainty off the table.
Exactly. This action reduces a significant source of uncertainty that had been weighing heavily on corporate investment decisions, on supply chains, and just overall business confidence. It's an additional layer of relief for investors, removing a major overhang that could have easily dampened this rally.
So we've identified these powerful macroeconomic currents driving the market, from inflation data shifting Fed expectations to even global trade truces providing some relief.
Right, the big picture stuff.
It's one thing to grasp these vast forces shifting beneath the market's surface. But for you as an individual investor, the real question often becomes, how do these huge forces actually manifest, both positively and negatively, at the level of individual companies, the ones you might hold or be thinking about buying?
Yeah, how does it trickle down?
Let's zoom in now from that grand economic stage to the nuts and bolts of quarterly earnings reports, where these big trends truly come alive, for better or worse. 2. Growth investing, philosophy, and high potential opportunities.
It's truly fascinating to see how these broad market rallies and the underlying macroeconomic themes like that Goldilocks narrative translate into specific sector and individual stock performance. The risk-on sentiment we're seeing, fueled by those factors, is particularly evident in sector leadership right now.
Absolutely clear.
On Tuesday, all 11 of the S&P 500's broad sectors finished in positive territory. That's pretty rare in itself, right?
It shows very broad participation, yeah. Not just one or two things working.
And the advance is clearly being led by the most growth-oriented and economically sensitive groups. The Technology Select Sector SPDR, the XLK, jumped a robust 1.6%.
Tech leading again?
And the Communication Services Select Sector SPDR, the XLC, surged an even more impressive 1.9%.
So big tech, media, telecom, all doing well.
This consistent leadership from technology and communications, which, house many of the market's premier growth companies,
Yeah.
it really signals strong investor confidence in future economic expansion, doesn't it?
It absolutely does. It indicates a clear preference for companies that investors believe can deliver outsized earnings growth in this kind of supportive economic environment. And we're seeing a similar pattern internationally, too, which reinforces the idea that these drivers are pretty universal right now.
Oh, really? Where else?
Well, in India, for example, the report notes that healthcare, metal, and auto stocks are serving as the primary drivers of gains, reflecting, sector-specific tailwinds, but also general investor optimism in those regions. It really feels like a synchronized global appetite for risk and growth at the moment.
But where it truly gets granular, and often most dramatic for individual portfolios, is at the individual stock level, especially among companies reporting their quarterly earnings right now.
Yeah, earnings season is where the rubber meets the road.
These reports, as you'll see, provide a clear, almost immediate lens through which to view the impact of these major market themes, everything from the boom in artificial intelligence to the subtle pressures of global trade policy. Let's talk about some standout winners first, the companies that really nailed it this quarter.
Okay. One of the biggest winners, certainly grabbing headlines, is Arista Networks, ticker ANET. They're a vital maker of high-performance computer networking equipment, especially for data centers.
ANET, okay. What do they do?
Their shares are surging an impressive 17.5% today, hitting a new record high.
Wow, 17.5%.
Yeah. The company delivered a truly stellar earnings report for its second quarter. Revenue grew a phenomenal 30% year over year.
30% growth. That's
It's
huge.
And net profit per share was up an equally impressive 35%. Both figures just handily beat analyst forecasts, which is always a strong signal.
So what drove that?
Management specifically cited powerful demand related to AI and cloud computing infrastructure as the key drivers. They're basically selling the critical gear needed for this massive AI build-out. And they even raised their full-year revenue guidance.
That's huge. Raising guidance is key.
It is. This is really a textbook example of a company executing flawlessly within a major secular growth trend, that indispensable build-out of AI data center infrastructure. They're right in the sweet spot.
Okay, and another notable gainer that really stands out, this one highlighting strength in the defensive but still innovative healthcare sector, is the biopharmaceutical firm, Gilead Sciences, GILD.
Gilead, yeah, the big name.
Its stock jumped a solid 8.3% on their news.
Also a strong move. What was their story?
Gilead posted stronger than expected revenue and adjusted earnings. It was primarily fueled by robust sales growth for Discovery, which is their flagship HIV treatment.
So strengthen their core franchise.
Exactly. They're benefiting from both rising demand for their established therapies and also getting higher average selling prices for the drug.
Yeah.
It really showcases how strong defensible product franchises, even in relatively mature therapeutic areas, can translate directly into significant shareholder returns when managed effectively.
But, earnings season isn't just about celebrating the winners. It's equally crucial, maybe even more so sometimes, for highlighting significant risks and unexpected headwinds that companies face.
Right, the other side of the coin.
And Supermicrocomputer, SMCI, serves as a really stark reminder here. They're a server manufacturer, another key player in the AI hardware space, actually.
SMCI, okay. What happened with them? Not good, I take it.
Not good at all. Its shares plunged a dramatic 18.3%.
Ouch. 80% down in this market.
Exactly. The company's fiscal fourth quarter revenue and adjusted earnings per share both fell short of consensus estimates. It signals a stumble in a sector that's otherwise red hot.
Any reasons given?
Management pointed to several headwinds. Things like increased costs related to tariffs, which we talked about.
The trade impact again.
Yep. Also, specification changes from a major customer, and even capital constraints that limited its ability to scale production fast enough. It serves as a stark reminder of the operational and geopolitical risks that can impact even companies riding these huge high-growth waves. It's not just about being in the right space. You have to execute flawlessly within it.
And perhaps the most dramatic example we've seen recently of how macroeconomic forces can impact a single company is the trade desk, TTD.
Oh, TTD, that was brutal.
Yeah. This advertising technology company stock plummeted an astonishing 38.6% in a single day.
Nearly 40%, just wiped out.
Now, their revenue actually grew nearly 19% year over year, which, in isolation sounds pretty good.
19% growth isn't bad.
But they slightly missed adjusted earnings expectations. But the critical issue here, the real kicker that sent the stock tumbling, was management revealing that some of its largest corporate clients are pulling back on their advertising budgets.
Why?
Specifically in response to those very tariff pressures and the associated economic uncertainty we discussed earlier. So, armed with this understanding of the current market pulse and these company examples, let's pivot now to understanding the investment philosophy that often benefits most from these kinds of trends, what we call growth investing. How do you actually approach finding the next Arista and hopefully avoid the next TTD or SMCI? 3. Growth investing, philosophy, and high potential opportunities. Now that we've seen the market in action, identified some winners and losers, and glimpsed the powerful macroeconomic forces at play, let's talk about how to truly approach this. To effectively identify high-potential growth stocks and to confidently analyze their prospects, it's absolutely essential to understand the philosophy that underpins this style of investing.
Right, the mindset matters.
Growth investing, at its core, it's a strategy focused on finding and investing in companies that are expected to grow their sales, their earnings, or their market share significantly faster than the overall market average.
Much faster, usually.
The core belief here is that these companies' extraordinary future potential isn't yet fully reflected in their current stock price, offering the prospect of substantial capital appreciation over time. You're betting on the future.
Absolutely. And the financial profile of a typical growth company is quite distinct. It often diverges significantly from more established, maybe slower growing businesses.
How so?
Well, these firms are frequently in the early or perhaps the aggressive expansionary phases of their life cycle. They're usually found in dynamic, innovative sectors, think cutting-edge technology, biotechnology, or rapidly emerging consumer markets.
The exciting stuff.
Often, yeah. And a hallmark of a growth company is its unique approach to capital allocation. Instead of distributing profits to shareholders as dividends, which is common for mature companies.
Like utilities or banks.
Exactly. These businesses aggressively reinvest nearly all their retained earnings back into the business itself. This capital fuels vital research and development. It expands marketing efforts to capture new customers, it facilitates strategic acquisitions to build market share, or it drives other operational expansion. It's all done with the singular goal of achieving or maintaining a dominant market position. Plow everything back in.
This intense focus on future potential rather than, say, current immediate profitability often leads to valuation metrics that can look quite high, maybe even scary, to someone who isn't familiar with this style of investing.
Right. The sticker shock can be real.
Growth stocks frequently trade at high price to earnings, or PE, ratios, meaning investors are willing to pay a much higher price for each dollar of a company's current or even projected future earnings. Similarly, they often have high price to sales, or PS, ratios.
They do. And it's because investors are essentially paying up for the expectation of superior growth in the years to come. They're betting heavily on where the company is going, not necessarily just where it has been today. It's kind of like buying a lottery ticket, but hopefully one with better odds based on a rapidly appreciating future.
Hopefully the better odds.
But what's fascinating here, and this is absolutely crucial for you, the investor, to understand, is that this potential for high reward is inextricably linked to higher risk.
No free lunch.
Exactly. The elevated valuations of growth stocks make them particularly sensitive to any disappointments. If a company fails to meet its ambitious growth targets, maybe due to a flawed product launch, maybe intensifying competition eats into market share, or perhaps an unexpected shift in macroeconomic landscape hits them.
Like the tariff issue for TTD.
Precisely. If that happens, its stock price can fall dramatically and swiftly as investors rapidly reassess its future prospects, and that high valuation suddenly looks unjustified. This inherent volatility means that growth investing is often best suited for investors with a longer time horizon, people who can withstand significant, sometimes stomach-churning price swings, trusting in the long-term trajectory of the business. You need patience.
Definitely need patience and maybe a strong stomach. So if growth investing is about future potential and higher risk, how does this compare to, say, value investing? They're often presented as two opposing philosophies, right? But they're quite different in practice. And why should our listener care about the distinction?
They are, and it's a crucial distinction for shaping your overall investment strategy and understanding market cycles. In contrast to growth, value investing focuses on finding well-established, stable companies that are trading at a discount to what the investor believes is their intrinsic worth.
So looking for bargains.
Essentially, yeah. Their current stock price is, in the value investor's eyes, less than what the company is truly worth based on its assets, its earnings power, its cash flows. These value stocks are often found in more mature, perhaps less exciting industries. They might have slower but more predictable growth rates, and they typically pay regular dividends to shareholders, offering income as well as potential appreciation.
So stability and income focused.
Generally, yes. They are usually considered to be less volatile and carry a lower risk profile than their growth counterparts, appealing more to investors seeking stability in current income streams.
Okay, to really break it down for you, let's maybe look at some key characteristics side by side, just to make it easier to grasp the fundamental differences.
Good idea.
For growth stocks, the primary goal is capital appreciation. You're betting on rapid growth. For value stocks, it's more about returns from uncovering that undervaluation and receiving consistent dividends.
Right. Growth versus undervaluation plus income.
Growth companies are often younger, innovative, pioneering emerging industries. Think tech, biotech. Value companies are typically mature, established businesses, operating in more stable foundational sectors.
Think financials, utilities, consumer staples.
When it comes to pricing and valuation, growth stocks are priced for that distant future potential. So you'll often see them trading at high PE ratios, high PS ratios.
Paying a premium for growth.
Value stocks, on the other hand, are priced below what's perceived as their intrinsic value. So you'll see lower PE ratios, lower price-to-book ratios.
Looking for a discount.
Growth companies prioritize reinvesting nearly all their earnings back into the business for expansion, aiming for market dominance. Value companies focus on generating stable, predictable earnings, often returning a significant portion to shareholders.
But reinvest versus return capital.
And dividends. Growth stocks usually pay low or no dividends because they need that cash for reinvestment. Value stocks often pay consistent, sometimes high-yield dividends, making them attractive for income-focused investors.
Growth needs cash. Value generates excess cash.
In terms of risk profile, growth stocks inherently have higher risk and higher volatility. They're extremely sensitive to missing those aggressive growth targets. They can soar, but they can also crash hard.
High beta. Often.
Value stocks generally carry lower risk and lower volatility, being less sensitive to broad market swings typically.
Lower beta. More defensive.
Finally, key sectors. Growth stocks are commonly found in technology, cutting-edge healthcare, consumer discretionary writing, innovation, and changing tastes. Value stocks tend to populate financials, utilities, industrials, consumer staples, sort of the backbone of the economy.
That's a great summary of the core differences, and it's really crucial to recognize that the performance of these two distinct styles isn't static. It's cyclical. It's heavily influenced by the prevailing macroeconomic environment.
Right, one style doesn't always win.
Exactly. While historical studies, looking back decades, often show that value stocks have tended to outperform over very long time horizons, growth stocks have actually been the dominant style for much of the past decade or more. Driven largely by the technological revolutions and that period of ultra-low interest rates we had post-financial crisis.
Okay.
Critically, growth stocks tend to thrive in periods of economic expansion and, most importantly for our current discussion, in environments with low or falling interest rates.
Why is that link so strong?
Because, as we touched on earlier, when interest rates are low, the future earnings of growth companies, which are often projected far out into the future, are discounted back to the present at a lower rate. This mathematically makes those future earnings worth more today.
Right, the present value calculation.
Precisely. Therefore, the current market environment, characterized by moderating inflation and these widespread expectations of Federal Reserve rate cuts, creates a powerful structural tailwind for growth-oriented stocks. It makes them a particularly timely focus for analysis right now.
Okay, understanding this framework, it really begs the question. Where are the most compelling growth opportunities right now, given this backdrop? Where should we really be looking to apply these growth investing principles for maximum potential impact? 4. Where growth opportunities lie. Sectors in focus.
Okay, so applying these principles of growth investing to the current landscape, especially with that Goldilocks backdrop we discussed and the expectations of falling rates, reveals several sectors that seem poised for substantial long-term expansion.
All right, let's get into those.
These sectors, according to the report we're analyzing, are really underpinned by powerful secular trends. These are long-term shifts that are fundamentally reshaping the global economy, not just cyclical ups and downs.
Okay, trend number 1.
First up, and perhaps the most talked about right now, the technology supercycle, specifically driven by the AI revolution.
AI, it's everywhere.
It really is. And what's truly fascinating here is that the technology sector seems to be in the early stages of what many analysts are calling a transformative investment supercycle. It's driven by the mass adoption and the accelerating capabilities of artificial intelligence.
So, not just hype.
The argument is, no, this isn't just another fleeting tech trend. It's potentially a fundamental technological shift, maybe akin to the advent of the internet itself or the mobile revolution. The scale of investment is absolutely immense. Global IT spending is projected to grow by a robust 9.3% in 2025 overall.
That's healthy growth.
But spending specifically on AI is forecast to expand at an astonishing compound annual growth rate, a CAGR, of 29% between 2024 and 2028.
29% CAGR. That's truly explosive growth.
It's a massive curve. And this revolution is being led by the world's largest tech companies, the ones people often call the hyperscalers.
Like Amazon, Microsoft, Google, Meta.
Exactly. Those giants are expected to invest a staggering sum, over $250 billion in AI-related capital expenditures, or CapEx, in 2025 alone, primarily to build out the next generation of data centers required to train and run these incredibly complex, advanced AI models. It's an infrastructure build-out on an epic scale.
Wow, $250 billion just from those few companies on AI infrastructure. That's incredible.
It is. And this massive capital outlay creates a durable and highly compelling investment theme often referred to as the shovels and picks play.
Ah, the gold rush analogy.
Precisely. Think about the historical gold rushes of the 19th century. The most consistent fortunes were often made not by the prospectors searching, often fruitlessly, for the elusive gold.
Right, most of them failed.
But by the shrewd merchants who sold them the essential tools, the shovels, the picks, the wheelbarrows, the blue jeans that everyone needed just to participate in the rush.
Okay, so how does that apply to AI?
In the current AI gold rush, the gold might be seen as the development of winning AI applications, which can be highly speculative and incredibly competitive. Who builds the next killer app? It's hard to know.
Right.
The shovels and picks, however, are the foundational hardware, the software, the underlying infrastructure, the chips, the networking gear, the cloud platforms that every single company needs to even begin participating in the AI revolution.
So investing in the enablers, not just the end applications.
Exactly. And the investment is flowing directly and powerfully to the providers of this essential infrastructure. NVIDIA, NVDA, is seeing its data center revenue explode from selling the specialized graphics processing units, GPUs, that are the absolute workhorses of AI training and inference.
They have a near monopoly there almost.
Almost. And their CUDA software platform, by the way, has created a truly formidable competitive moat. It makes it incredibly difficult for competitors to catch up quickly.
Right, the software locks people in.
It does. And then you have Arista Networks, ANET, which we mentioned earlier. They're experiencing record demand for the high-speed networking switches that connect all these powerful AI servers together, ensuring data can flow at the incredible speeds AI requires. This focus on the tangible, non-discretionary infrastructure spending offers a potentially more robust and less speculative way to invest in the AI theme than trying to predict which consumer-facing AI app or large language model will ultimately win out.
That makes a lot of sense. Focus on the infrastructure providers. But is it just those big names, the Magnificent Seven and the like, benefiting? Or is the opportunity broadening out?
Well, while the so-called Magnificent Seven tech giants were certainly the initial and most visible beneficiaries, the report notes that the opportunity is now broadening significantly. It's starting to encompass a wider ecosystem of companies all across the market cap spectrum.
Like who? What other areas?
This includes companies specializing in things like data center cooling systems. These AI chips run incredibly hot.
Ah, okay. Cooling is critical.
Critical. Also, enterprise AI software companies that are integrating AI into specific business processes, IT services firms that help other companies actually implement AI solutions, and manufacturers of specialized chips like ASICs, application-specific integrated circuits, which are custom chips designed specifically for AI tasks, maybe more efficiently than GPUs for certain things.
Okay, let's maybe quickly list some of these key players and their specific roles again, just to make it concrete,
Yeah.
because it sounds like a really diverse landscape.
Sure. So obviously, NVIDIA, dominant provider of those essential GPUs for AI training and running, with its CUDA software platform solidifying its competitive edge.
The leader.
Then Microsoft, MSFT,
Yeah.
a key AI beneficiary through its Azure cloud platform where AI models are deployed, and also through its deep integration of AI features like Copilot across its entire software suite, Office, Windows, everything.
Integrating it everywhere.
Arista Networks, ANET, supplies those critical high-speed switches and networking gear for AI data centers, directly benefiting from all that hyperscaler capital expenditure.
The plumber for AI data centers.
Kind of, yeah. Then you have Palantir, PLTR, a leader in data analysis and AI platforms, specifically for government and large commercial clients. They represent a powerful player in the application layer of AI, helping organizations make sense of complex data using AI tools.
Making AI useful for big organizations.
And maybe a smaller but highly specialized company, InnoData, INOD. They provide the high-quality training data that is absolutely essential for building and scaling these generative AI systems.
Ah, the data providers. Crucial, but often overlooked.
Crucial. Because without good data, high-quality, well-labeled data, these powerful AI models are basically useless. Garbage in, garbage out. These really are the shovels and picks of the AI revolution, poised to ride this supercycle potentially, regardless of which specific AI applications ultimately win the race.
Okay, that's a compelling case for the AI infrastructure play. Moving beyond pure tech, though, the healthcare sector also presents a truly compelling long-term growth opportunity. What's driving that?
Well, healthcare is driven by two incredibly powerful and enduring forces. First, the simple demographic reality of an aging global population. Older people inevitably consume more healthcare services.
A trend that's not reversing.
Not anytime soon. And second, we're living through a period of unprecedented scientific innovation in medicine that is constantly pushing the boundaries of what's possible. It's a vast sector offering a really diverse range of investment opportunities, from high-growth biotechnology startups to established medical device leaders.
So where are the most exciting areas within healthcare right now?
Well, one of the most exciting areas is definitely biotechnology, where the pace of scientific discovery is accelerating dramatically. A key enabler here, and this is truly transformative, has been the precipitous drop in the cost of genome sequencing over the last decade or two.
Right, sequencing a genome used to cost millions, now it's hundreds.
Exactly. That massive cost reduction has unlocked entirely new therapeutic pathways that were previously unimaginable, allowing scientists to understand diseases at a genetic level. This is leading to groundbreaking discoveries in areas like RNA interference or RNAi.
What's that?
It's a revolutionary technology that can essentially silence specific disease-causing genes. Companies like Alnylam Pharmaceuticals, ALNY, are pioneers in this space. Similarly, firms like ARGX are developing novel antibody-based therapies for complex autoimmune diseases, targeting conditions with really high unmet medical needs.
And simultaneously, we're seeing massive new markets being created by what people call blockbuster drug categories, right?
Absolutely. The development of GLP-1 agonists for the treatment of diabetes and, crucially now, obesity, is proving to be a true game changer in public health and for the companies involved.
The weight loss drugs, huge story.
Huge story. Companies like Eli Lilly, LLY, and Novo Nordisk, NVO, are poised to capture a multi-billion-dollar market, potentially hundreds of billions globally, addressing a major global health challenge that impacts hundreds of millions of people. Sales in these types of specialty drug categories are expanding at an incredibly rapid clip. The report mentions 15%, 17% per year, which just shows how much unmet need there is out there. And AI, which we just talked about in tech, is also rapidly emerging as a transformative force within healthcare itself. It's impacting virtually every aspect of the industry.
How is AI being used in healthcare specifically?
Well, it's being used to dramatically accelerate drug discovery, for one. sifting through vast amounts of biological data to identify promising drug compounds far faster than traditional methods ever could. It's improving the accuracy of medical diagnostics, helping doctors identify diseases like cancer earlier and more precisely from images or scans. And it's dramatically streamlining administrative tasks, like processing insurance claims, which could save health insurers hundreds of millions, maybe billions, in costs, allowing them to focus resources elsewhere, hopefully on patient care.
Any company examples there?
Sure. Companies like Veracyte, VCYT, which uses genomic and AI tools for advanced cancer diagnostics, are right at the forefront. And Doximity, DOCS, which operates a leading digital platform for U.S. medical professionals, is leveraging technology to improve workflows and communication, making the whole system more efficient.
Now, the report suggests a fascinating barbell strategy for healthcare investors, which I find particularly appealing. It seems like a balanced approach to risk and reward. Can you explain that?
Yeah, the barbell strategy is interesting. On one end of the barbell, you have the high-octane, pure-play growth stories, think the specialty drug makers developing novel treatments, the innovative biotechs working on cures for rare diseases. These have huge upside potential, but also higher risk.
Okay, the high growth, high risk end.
Exactly. But on the other end of the barbell, you have the established wide moat industry giants, the big pharma companies, the large medical device makers. And notably, analysis from firms like Morningstar suggests that several of these large dominant players companies like Roche, RHHBY, and GSK, are actually trading at a significant discount to their estimated fair value right now.
Ah, so finding value within the growth sector.
Precisely. This presents an excellent opportunity for you, the listener, to potentially anchor a healthcare portfolio with stable, maybe undervalued leaders who possess strong balance sheets, global reach, and continue to innovate through their own massive R&D pipelines, while also allocating a portion of your capital to those higher risk, potentially higher reward emerging growth companies that could deliver exponential returns if their science pans out.
It's a way to participate in the cutting-edge innovation without putting all your eggs in one, maybe very volatile basket.
Exactly that. It balances risk and reward across the sector.
Okay, just to give a few more examples of key companies in this diverse healthcare space. We mentioned Eli Lilly, LLY, a recognized leader in that rapidly expanding market for obesity and diabetes treatments, poised for potentially massive growth.
A clear leader there.
Argenx, ARGX, an innovator developing antibody-based treatments for rare autoimmune diseases, addressing critical unmet needs.
Cutting-edge science.
Intuitive Surgical, ISRG, the dominant player in robotic-assisted surgery, benefiting from the aging population and the increasing adoption of minimally invasive procedures.
Huge long-term trend.
Veracyte, VCYT, using advanced genomic and AI tools for sophisticated cancer diagnosis, aiming for earlier and more precise detection.
AI in diagnostics.
And Doximity, DOCS, operating that leading cloud-based digital platform for U.S. medical professionals, benefiting from the accelerating digitization of healthcare workflows and communication.
The network effect in healthcare.
All right, that covers AI and healthcare. Now let's turn our attention to the global energy sector, which is currently undergoing a profound and, frankly, irreversible transition.
Absolutely a massive shift underway.
Investment in clean energy technologies is reaching absolutely unprecedented levels. This report highlights that global investment in clean energy is forecast to hit a staggering record of $2.2 trillion in 2025 alone.
2.2 trillion. It's an enormous capital reallocation happening right now.
What's driving this surge?
It's really driven by a powerful convergence of factors. First, the ongoing critical effort to reduce carbon emissions and combat climate change. That's still a major driver.
The environmental push.
Second, the increasing cost competitiveness of renewables. Solar and wind are now often cheaper than building new fossil fuel plants in many parts of the world.
Economics are shifting.
Absolutely. And third, and this is crucial, there's a renewed, pressing focus on energy security by nations and corporations alike, prompted by geopolitical instability like the war in Ukraine and supply chain disruptions we saw during the pandemic.
Ah, so it's not just about being green anymore.
Exactly. What's truly fascinating here is how the narrative surrounding renewable energy investment is fundamentally maturing. While climate goals remain a significant factor, the International Energy Agency, the IEA, now explicitly cites energy security concerns as a key driver of the record $3.3 trillion in total global energy investment, not just the clean energy portion.
That's a huge fundamental shift in framing, isn't it? It transforms renewables from what some might have dismissed as a green dream, dependent mainly on subsidies and fluctuating public sentiment,
Right, dependent on politics.
into a core strategic and economic imperative for national and corporate security. This structural change makes the growth trend in the sector far more durable, potentially less susceptible to the whims of political cycles or short-term economic headwinds. It's about national interest and self-sufficiency as much as environmental goals now.
That durability is key for long-term investors. And within the clean energy space, solar power and energy storage are emerging as the clear, undeniable leaders. They're attracting the lion's share of that investment capital.
Solar and batteries?
Yep. Investment in solar photovoltaic, or PV technology, is expected to reach $450 billion in 2025. That makes it the single largest category of energy investment globally, bigger than oil and gas exploration.
Bigger than oil and gas. Wow.
Concurrently, investment in battery storage solutions is surging, projected to exceed $65 billion. Storage is absolutely critical for ensuring grid stability and reliability with intermittent power sources like solar and wind. Without effective, large-scale storage, the widespread adoption of renewables becomes far more challenging logistically.
Right, you need power when the sun isn't shining or the wind isn't blowing. Batteries solve that. This undeniable trend is creating significant growth opportunities for companies all across the entire clean energy value chain. Utility-scale developers are building renewable capacity at a massive scale. For example, in India, the report mentions Tata Power, TPCL. They're aggressively adding 1.7 gigawatts of renewable capacity and have a project pipeline of nearly 5.5 gigawatts. That shows impressive commitment.
Huge scale in markets like India.
In the U.S., NextEra Energy, NE, has firmly established itself as a global leader in generating power from wind and solar. They skillfully combine a stable, regulated utility business with a fast-growing, high-potential renewable energy development arm.
A nice hybrid model.
In pure-play technology companies like First Solar, FSLR, they manufacture advanced thin-film solar panels and, critically, control their own vertically integrated supply chain. They seem incredibly well-positioned to capitalize on this soaring demand, especially benefiting from Made in America incentives that prioritize domestic production.
That domestic production angle is becoming increasingly important for resilience. And let's not forget Brookfield Renewable, BEP. They operate a globally diversified portfolio of hydroelectric, wind, solar, and energy storage assets. This provides really broad exposure to the entire clean energy transition, offering a more diversified play on the sector's overall growth rather than betting on one specific technology or region.
So, lots of different ways to play the energy transition theme. Okay, we've discussed where to look for growth across these powerful themes: AI, healthcare, energy transition. Now, let's pivot to perhaps the most essential tool in any serious investor's arsenal for actually evaluating these opportunities once you find them: mastering the earnings report.
Absolutely fundamental.
You can have all the big picture ideas in the world, but if you can't assess the health and trajectory of an individual company, you're essentially flying blind. The Analyst's Toolkit. Mastering the earnings report. A deep, methodical understanding of a company's quarterly earnings report is truly the cornerstone of fundamental analysis for any serious investor. These reports provide a regular, detailed, and legally mandated look into a company's financial health and operational performance.
Yeah, it's your primary data source from the company itself.
Moving beyond the splashy headlines and the analyst sound bites on TV to actually dissect the underlying data yourself is a critical skill. It's crucial for anyone looking to make truly informed investment decisions, not just follow the herd. That's precisely what we want to help you master here.
That's right. Publicly traded companies in the U.S. are required by the Securities and Exchange Commission, the SEC, to file a quarterly report known typically as a Form 10-Q after each of their first 3 fiscal quarters. The fourth quarter results are in the annual 10-K.
Okay, the 10Q.
This document, while it's technically unaudited, meaning it hasn't gone through a full, independent, external review like the annual 10-K report, contains an absolute wealth of information. It's meticulously composed of several key parts, and each tells a different, vital part of the company's story for that quarter.
Let's truly break down the anatomy of a 10Q then. Knowing these sections is your first step to unlocking its power. First, you have the income statement. Most people know this as the profit and loss, or P&L statement.
The P&L, yeah, top to bottom line.
This document summarizes a company's financial performance over a specific period, usually the 3-month quarter. It effectively shows the revenues generated by selling its products or services and all the expenses incurred to generate those revenues. Key line items for you to scrutinize here include top-line revenue or sales,
The starting point.
cost of goods sold, the OGS, which reveals how much it costs to actually produce what they sell,
Direct costs.
which gives you gross profit, revenue minus KGS. Then you have operating expenses, things like selling, general and administrative, SG&A, and research and development, R&D. These give you insight into overhead costs and how much they're spending on innovation.
SG&A and R&D, critical for growth companies.
Subtracting those gives you operating income, a measure of core profitability. And finally, after interest and taxes, you get that all-important bottom line, net income or profit.
From revenue all the way down to net income. Next up, there's the balance sheet. Now, unlike the income statement, which shows performance over time, like a video, the balance sheet is a static snapshot of a company's financial position at a single, precise point in time, usually the last day of the quarter.
Like a photograph.
Exactly like a photograph. It's elegantly structured based on the fundamental accounting equation. Assets equals liabilities plus shareholders' equity.
Assets, liabilities plus equity. Gotta remember that one.
You do. The balance sheet explicitly reveals what a company owns. Its assets, like cash, inventory, property, equipment. What it owes, its liabilities, like debt, accounts payable to suppliers, and the net worth attributable to its owners, shareholders' equity. It is absolutely essential for assessing a company's financial health, its solvency, its ability to meet long-term obligations, and its leverage, which is how much debt it's using to finance its assets.
Okay, income statement, balance sheet.
Oh, yeah.
What's next?
Then you have the cash flow statement. And honestly, for many seasoned analysts, this may be the single most critical statement for understanding a company's true operational health and financial viability.
More important than profit. Why?
Because it meticulously tracks the actual movement of cash both into and out of the company during the reporting period. Profit on the income statement can include non-cash items or be influenced by accounting choices. Cash is king, as they say.
Cash is fact.
Pretty much. It's broken down into 3 core activities. Operating activities, cash generated from or used by the core day-to-day business operations. Investing activities, cash used for buying long-term assets like factories or generated from selling them. And financing activities, cash from issuing debt or stock, paying dividends, buying back stock.
Operating, investing, financing.
Okay. This statement is crucial because, as I hinted, a company can actually show a significant profit on its income statement due to accounting rules, like recognizing revenue before cash is collected, but still be running out of real cash in the bank. The cash flow statement bridges this gap. It provides a clear, unvarnished picture of a company's liquidity and its fundamental ability to generate the cash needed to fund its operations and future growth without constantly having to borrow more money or issue more shares.
Okay, that makes sense. Profit is opinion, cash is fact. Kind of.
Yeah.
What's the last major piece?
Finally, there's the management discussion and analysis, or MD&A. This is the narrative, the qualitative portion of the report where management truly provides context for all those raw financial numbers.
So management's commentary.
Exactly. In the MD&A, executives are required to explain the factors that influence the quarter's performance, why sales went up or down, why margins changed. They discuss key business trends they are observing in their industry or with customers. They highlight known risks and uncertainties that could impact future results. And often, they provide their outlook, their guidance for the future.
The forward-looking stuff.
Yep. This qualitative section is an absolutely invaluable source of information and strategic insight that you simply cannot find in the raw numbers alone. It's where you get to hear the company's story in its own words, complete with both the challenges and the opportunities they see ahead. You have to read between the lines sometimes, but it's critical context.
Okay, knowing the parts, income statement, balance sheet, cash flow, MD&A, that's one thing, and it's a great start. But how do you actually use them effectively? How do you turn these complex documents, which can be dozens or hundreds of pages long, into actionable insights for your investment decisions? 6, how to analyze earnings, a 5-step process. Analyzing an earnings report, especially a dense 10Q, can certainly feel daunting. It can seem like trying to decipher an ancient text sometimes.
Especially the footnotes.
Exactly. But the report we're drawing from lays out a systematic 5-step approach that can make the process much more manageable, insightful, and highly effective for you, the listener. It's a robust framework for dissecting a company's quarterly performance and translating all those numbers into real understanding.
All right, step one, check headline numbers versus expectations. The market's initial, often knee-jerk reaction to an earnings release is almost always driven by two primary headline numbers:
Yeah.
total revenue or sales and earnings per share or EPS.
Revenue and EPS, the big two.
They are. Your very first step is to quickly compare these reported figures to the consensus estimates of Wall Street analysts. You can usually find these estimates on major financial news websites. A significant beat or miss is generally considered to be a deviation of, say, 2% or more from that consensus estimate.
Okay, beat or miss by 2%. What if it's close?
An EPS can result within 2% of the consensus is typically viewed as inline and usually doesn't cause a huge immediate market reaction unless guidance is very different. This first check just sets the immediate tone for how the market perceived the report at first glance.
Okay, step one, check the headlines versus the street. Step two, analyze profitability trends. This sounds like where you move beyond just the top-line numbers and delve into the company's true operational health.
Exactly. You need to scrutinize the key profit margins. We mentioned them earlier. Gross margin, what's left after the direct costs of producing goods or services. Operating margin, what's left after all operating expenses like SG&A and R&D. And net margin, the final profit percentage after everything, including interest and taxes.
Gross operating net margins. Okay, what are you comparing them to?
You need to compare these margins meticulously to the same quarter in the previous year. That's the year-over-year or YoY comparison. This helps account for seasonality. And also compare them to the immediately preceding quarter, the quarter-over-quarter or QoQ comparison to see the sequential trend.
So YoY and QoQ margin trends, what are you looking for?
Expanding margins are generally a very positive sign. It suggests the company has pricing power, it can raise prices without losing customers, or it's managing its costs effectively, or perhaps it's becoming more operationally efficient as it scales. Conversely, contracting margins can be a significant red flag. It might indicate rising input costs, intense competitive pressure forcing price cuts, or maybe a fundamental weakening of the business model. You have to understand why the margins are moving. All right, step three, scrutinize the financial statements for anomalies. This is where you really dig into the details of the balance sheet and the cash flow statement. You're looking for subtle but potentially telling unusual changes or trends that might not be immediately obvious just from the headlines or the income statement.
Okay, detective work time. What kind of anomalies?
For example, is inventory on the balance sheet growing much faster than sales revenue? This could signal that the company is struggling to sell its products. Maybe they're building up obsolete or undesirable stock that they'll eventually have to write down.
Inventory piling up is bad. Got it. What else?
Or are accounts receivable, that's the money owed to the company by its customers, ballooning disproportionately compared to sales growth? This might indicate that the company is extending overly lenient credit terms just to boost sales numbers, which is risky. Or, more concerningly, it could mean its customers are actually struggling to pay their bills on time.
So check if customers are paying slower.
Exactly. And it's also vital, as we discussed, to compare net income from the income statement directly to cash flow from operations from the cash flow statement over time. A significant and consistent divergence here, like profits going up but operating cash flow staying flat or going down, can be a huge red flag. It strongly suggests those reported profits aren't converting into real spendable cash.
Okay, check headlines, analyze margins, scrutinize financials for weird stuff. Step four, dissect management's guidance or forward-looking statements. You said earlier this is arguably the single most critical part of the whole analysis. Why is guidance so important?
Because stock prices are inherently forward-looking instruments. They reflect investors' collective expectations about a company's future earnings and cash flows, not just its past performance. While an earnings report itself is, by definition, a look back at the previous quarter.
It's history.
Right. The guidance section, usually found in the press release or discussed on the earnings call, is management's official forecast for the future, typically the next quarter and sometimes the full fiscal year.
And the market cares more about the future than the past.
Overwhelmingly so. A company can report absolutely stellar results for the past quarter, beating all analyst estimates handily. But if it then issues weak or cautious guidance for the upcoming quarter or full year, its stock is highly likely to fall, sometimes sharply.
Even after a great quarter.
Absolutely. The market, quite simply, cares far more about where a company is going than where it has just been. A perfect illustrative example cited in the report is GoDaddy, the web domain and hosting company, ticker GDDY. A while back, they actually beat both sales and profit forecasts in their quarterly report. That's good, right?
Yeah, sounds like a beat.
Yet, their stock dropped over 11% immediately after the report was released. Why? Because buried in their commentary, they warned of a future negative impact on their business stemming from an upcoming change in domain registry services. They signaled a potential hit to future revenues.
Ah, so the past was good, but the future looked worse. Market hates that.
Exactly. This perfectly highlights how guidance can completely trump past performance in the eyes of investors. Now, you also need to be aware of the safe harbor legal disclaimer that typically accompanies all forward-looking statements in these reports.
The legal boilerplate.
Right. This protects companies from liability if these projections ultimately prove to be inaccurate, which, frankly, they often are. It's one reason why management often tends to err on the side of conservatism when issuing guidance they'd rather underpromise and overdeliver.
Okay, that makes sense. Guidance is king. What's the final step?
Step 5. Review the earnings call and analyst revisions. So the report comes out, but the process isn't over. Not quite. The earnings release document isn't the end of the story for that quarter. After the numbers hit the wires, company executives, usually the CEO and CFO, typically host a conference call.
The earnings call.
Yep. They discuss the results in more detail, add color commentary, and, crucially, they answer questions from a panel of Wall Street analysts who cover the company. The Q&A session is often the most revealing part of the entire call,
Why the Q&A?
because the analysts who follow the company closely will probe management on the areas of greatest concern, the inconsistencies they spotted, or the uncertainties about the future. Reading the transcript of this Q&A, which is usually available online shortly after the call, can provide deep, qualitative insights into management's thinking, their confidence level, and the key challenges or opportunities the business is facing. You hear the tone, the hesitation, the conviction.
So listen to or read the call transcript. What about analyst revisions?
Right. In the days and weeks following the earnings report and call, you should diligently monitor how those analysts revise their future earnings estimates for the company based on the new information. A wave of upward revisions across the analyst community is generally a strong bullish signal, indicating renewed confidence in the company's prospects. Conversely, widespread downward revisions are a major concern, often signaling a loss of faith in the company's future earnings power. You can track these revisions on most financial data platforms.
Okay, that's a really solid 5-step process.
Yeah.
Let's quickly summarize that earnings analysis checklist again, just to keep it actionable for everyone listening.
Good idea. So first, headline numbers. Compare reported revenue and EPS to the consensus estimates. Was it a beat, a miss, or in line? Get that initial read.
Got it.
Profitability. Analyze gross margin and operating margin trends critically, both YoY and QoQ, and read management's explanation in the MD&A for why they changed.
Okay, margins and why. Next.
Financial statements. Dig into the balance sheet and cash flow statement. Specifically, check inventory growth versus sales and accounts receivable growth versus sales. Most importantly, compare net income to cash flow from operations over time. Look for divergences.
Find the anomalies. Step 4.
Guidance. Dissect management's revenue and EPS guidance for the next quarter and the full year. Was it raised, lowered, or just maintained compared to previous expectations? This tells you about the future.
The crucial future outlook. And finally,
Follow-up. Read the analyst Q&A section of the earnings call transcript, listen for the tone, and then track the subsequent analyst estimate revisions in the days following the report. See if the experts are getting more or less bullish.
that's a truly comprehensive approach. It turns the potentially daunting task into a manageable step-by-step process for anyone. But, equally important as finding the good stuff is knowing what not to miss. The potential pitfalls, the glaring warning signs that could save you from significant losses down the road. 7. Identifying red flags and warning signs. Just as important as identifying positive trends and promising growth is the critical ability to spot potential problems, sometimes even before they become widely known or reflected in the stock price.
Absolutely. Avoiding the landmines is half the battle.
A thorough analysis of an earnings report and a company's overall financial health involves actively looking for what we call red flags. These are warning signs that could signal underlying financial distress, maybe aggressive accounting practices, or even in some extreme cases, fraudulent activity.
Let's start with some key financial statement red flags you should always be on the lookout for. Be very wary of inconsistent or unusual revenue growth that isn't robustly supported by a corresponding healthy increase in cash flow from operations.
So revenue up, but cash flow not following.
Exactly. Companies, unfortunately, can artificially boost reported revenue by various means. They might record sales before they are truly earned according to accounting rules. Maybe they make fraudulent sales to related parties that aren't legitimate, or perhaps they simply ignore expected customer returns when booking revenue.
Sneaky accounting.
It can be. Similarly, expenses can sometimes be manipulated. A company might underrecord the cost of its inventory, or fail to write off inventory that's clearly obsolete or slow-moving, or maybe just delay recognizing expenses until a later period. These kinds of manipulations create a deceptive picture of profitability that isn't sustainable.
Okay, what's another one? I've heard the term cookie jar accounting. What does that mean?
Yeah, cookie jar counting is a subtle but insidious red flag to watch out for. It's essentially a practice where a company uses various accounting tricks to smooth out its earnings over time, making its performance look artificially stable and predictable quarter after quarter.
Why would they do that?
Usually to consistently meet or just beat Wall Street analyst expectations, which the market rewards. For example, a company might create excess reserves, maybe overestimate potential bad debts or warranty costs in a very good quarter. They're effectively putting cookies in the jar for later.
Setting aside profits for a rainy day, sort of.
Exactly. Then, in a subsequent bad quarter where they might miss estimates, they'll dip into this cookie jar by reversing some of those excess reserves, which artificially boosts reported earnings and helps them meet expectations again. A large or unusual amount of income reported under the other income line item on the income statement, especially if it seems non-recurring or unrelated to the core business, can sometimes be a sign of this practice. You have to ask where that other income came from. And this next one, honestly, is one of the most significant and potentially alarming red flags an investor can possibly find: a consistent divergence of profit and cash flow.
We keep coming back to this one, profit versus cash.
Because it's critical. If a company consistently reports strong and growing net income on its income statement, painting a rosy picture of profitability, but its cash flow from operations, CFO, on the cash flow statement is weak, stagnant, or most alarmingly, consistently negative,
That's bad news.
it strongly suggests that the reported profits are not translating into real, tangible cash in the bank. This can be a sign of overly aggressive accounting practices, like booking revenue way too early before cash is collected. Or, more fundamentally, it could point to a deeply flawed business model that simply consumes cash faster than it generates it, even if it looks profitable on paper. It's like that analogy. The car's speedometer, profit says 100 miles per hour, but the fuel gauge, cash flow, is on empty. You're not going much further.
Okay, that's a powerful one. What about the balance sheet? Any red flags there?
Absolutely. You must always beware of excessive debt and a weakening balance sheet. A company's underlying financial health can deteriorate significantly over time, even if its income statement looks superficially okay for a quarter or two. You need to look for high or rapidly increasing debt-to-equity ratios. That indicates a growing reliance on borrowed money, which increases financial risk.
Too much leverage.
Right. Watch for maxed out lines of credit, which means they might not have access to emergency funds. Or look for a significant increase in the average age of accounts receivable, often called days sales outstanding or DSO. If that number is climbing fast, it means customers are taking longer and longer to pay their bills. These are all critical signs of potential financial distress, over-leverage, and maybe impending liquidity problems. It signals the company might struggle to meet its short-term obligations like payroll or supplier payments. And remember, the red flags aren't just in the numbers. There are also crucial qualitative red flags to consider. These often speak more to the integrity and stability of the company's management and its internal controls.
Like what kind of qualitative signs?
One big one is frequent management or auditor changes. A high rate of turnover in the executive suite, especially among key financial officers like the chief financial officer, CFO, or frequent changes in the company's independent auditing firm can be a major warning sign.
Why is that a red flag?
Well, high C-suite turnover might indicate internal strife, a lack of cohesive strategic direction, or maybe disagreements about the company's health or strategy. Frequent auditor changes are particularly concerning. It could suggest serious disagreements between management and the auditors over accounting practices, or maybe even pressure from management to get the auditors to sign off on overly aggressive or questionable financial reporting. Good auditors sometimes resign or get fired when they push back.
Okay, management churn, auditor changes. What else?
Another potent qualitative red flag is unexplained changes in accounting policies. Companies are allowed to change their accounting methods sometimes, but they're required by accounting rules like GAAP or IFRS to fully disclose these changes and provide clear, logical justifications for why they are making the change.
They have to explain it.
They do. A sudden shift in an accounting policy, maybe how they recognize revenue or value inventory without a clear and compelling business reason, could potentially be an attempt to obscure poor underlying performance, manipulate financial results to look better, or simply make the company appear more profitable than it truly is under the old method. You always have to ask, why are they changing this now? Does it make legitimate business sense? Or does it just conveniently boost reported numbers? Now, while any single red flag we've discussed certainly warrants further, rigorous investigation, certain combinations of red flags can be particularly indicative of a company in serious, maybe even structural trouble.
Multiple red flags together or worse.
Much worse. An especially potent and dangerous combination is what some analysts might term the unholy trinity of red flags. This involves seeing all three of these things happening at the same time.
Okay, what's the unholy trinity?
Number one, declining profit margins, meaning the core business itself is becoming less profitable over time.
Okay, less profitable core business.
Number two, negative cash flow from operations, despite positive reported net income, meaning those reported profits aren't turning into actual cash needed to run the business.
Burning cash despite showing profits.
And number three, rising debt levels, meaning the company is borrowing more and more money, likely just to fend its operational cash shortfall and stay afloat.
Getting deeper in debt to cover losses.
Exactly. A company exhibiting all three of these characteristics simultaneously is facing a truly perilous situation. Its core business is becoming less profitable, its day-to-day operations are consuming rather than generating cash, and it is borrowing money, often just to fund this daily shortfall. This pattern, this unholy trinity, is a much stronger predictor of future financial distress, maybe even bankruptcy, than any one of these metrics viewed in isolation. It serves as a powerful pattern recognition tool for astute investors trying to avoid blowups.
That's a really clear and frankly scary combination to look out for. Let's give everyone a final quick summary table of those key financial red flags to keep in their mental toolkit when looking at reports.
Good idea. Keep these in mind. Declining profit margins, signals raising costs, tough competition, or maybe a loss of pricing power. Find this on the income statement by tracking gross and operating margins over time, YoY and QoQ.
Okay.
Revenue not backed by cash suggests aggressive revenue recognition or potentially even fake sales. Detect this critical divergence by comparing revenue growth, income statement, to cash from operations growth, cash flow statement.
Is that right?
Rising inventory levels faster than sales might mean difficulty selling products or holding obsolete stock. Check the balance sheet, comparing inventory growth rate to sales growth rate.
Right.
Ballooning receivables faster than sales could mean customers aren't paying on time or credit standards are too loose. Look at the balance sheet again, comparing accounts receivable growth to sales growth.
Okay. Last one.
High or rapidly rising debt. A clear sign of financial distress, over-leverage, or liquidity risk. Find this primarily on the balance sheet. Look at debt-to-equity ratio trends, and also meticulously review any associated debt covenants described in the footnotes to the financial statements. Breaking those can trigger defaults.
Okay, we've covered a lot of ground. We've looked at the bullish market, the macro drivers, the key growth sectors, how to analyze earnings, and importantly, what red flags to watch out for. So what does this all mean when we try to bring it all together? How should an investor synthesize this information? 8. Synthesis and concluding remarks. So what does this all mean when we bring it together? We've gone through the market landscape, the drivers, the growth sectors, the analysis tools, the analysis of the current market environment and future growth prospects seems to lead us to a fairly clear and actionable conclusion, at least according to this report.
Yeah, I think the synthesis points towards a specific strategy right now.
It seems the landscape as of mid-August 2025 is viewed as highly favorable for a growth-oriented investment strategy. The primary driver of this outlook is that profound macroeconomic shift. We discussed the move toward a more accommodative monetary policy, with moderating inflation, giving the Federal Reserve that clear runway to potentially begin cutting interest rates soon.
Right. And that environment of lower or falling rates structurally benefits growth stocks. As we said, it mathematically increases the present value of their future earnings streams, and it generally signals broader confidence in continued economic expansion, which growth companies need to thrive. However, and this is a really critical caveat, always a favorable macro environment is not a guarantee of success for every stock.
Right, a rising tide doesn't lift all boats equally, especially leaky ones.
Exactly. The market's recent powerful performance is being fueled by a handful of truly powerful secular trends. We focused on the revolutions in artificial intelligence, the ongoing wave of healthcare innovation, and that crucial energy transition towards security and sustainability. But investing successfully in these areas requires far more than simply buying into a popular theme or a hot acronym.
You can't just buy the hype.
No. It demands a disciplined and rigorous application of the analytical tools we've outlined in this deep dive. The ability to actually dissect a company's earnings report, to distinguish between headline noise and underlying profitability trends, and most critically, to identify those red flags that signal potential danger. That is what truly separates a successful long-term growth investor from someone just speculating or chasing momentum.
Therefore, the strategic recommendation coming out of this report, for you, our listener, seems to be a clear twofold approach. First, focus your portfolio around those identified secular growth themes. Concentrate your capital allocation and your research efforts around those durable multi-year growth trends. The indispensable AI infrastructure build-out, the accelerating wave of innovation in biotech and medical technology, and the global push for energy security through renewables. These appear to be the powerful currents carrying the market forward for the foreseeable future.
That's the thematic focus. Find the big waves. And second, and just as important, apply rigorous fundamental analysis within those themes. Don't just buy any company related to AI or clean energy. Select individual companies based on their demonstrated fundamental strength. Seek out businesses with consistently expanding profit margins, strong and reliably positive cash flow from operations, and manageable balance sheets that aren't burdened by excessive debt.
So use the tools we discussed.
Exactly. Use that five-step earnings analysis process we walked through to validate a company's past performance and, crucially, to scrutinize its forward-looking guidance. And always be vigilant in screening for those financial and qualitative red flags we discussed, especially that dangerous unholy trinity. Discipline is paramount.
Finally, it's really important to remember the fundamental nature of growth investing itself. We talked about this. It is inherently more volatile and prone to sharper swings, both up and down, than perhaps other investment styles like value investing.
Higher potential reward often comes with higher volatility.
So to manage this elevated risk effectively, diversification across the identified themes and maybe even within them, plus having a genuinely long-term investment horizon are not just advisable, they are absolutely essential. They're essential for you to successfully weather the inevitable short-term market fluctuations and hopefully capture the substantial long-term returns these powerful secular trends promise over years, not just months.
Patience and diversification are key shock absorbers for growth investing. By combining that thematic focus on the most powerful transformative trends of the next decade with a disciplined, fundamentals-based approach to selecting the actual securities, the modern investor is arguably exceptionally well-positioned. Well-positioned to navigate both the opportunities and the challenges of the current market and potentially build significant long-term wealth. It's really about being smart and diligent, not just trying to get lucky on the next hot trend.
So, recapping the practical implications here, we've given you a comprehensive overview of the current bullish market conditions, the profound macroeconomic forces driving it all, the specific growth sectors that appear poised for long-term expansion, and hopefully a powerful practical toolkit for dissecting earnings reports like a seasoned pro. Our aim throughout this deep dive was really to give you the clarity and the confidence to approach the market more strategically and with deeper insight than just following headlines.
And maybe if we step back for just one final thought, looking at the broader context, while the market right now is intensely focused, maybe myopically focused, on the next quarter's earnings report and those crucial next interest rate moves by the Fed.
The short-term noise.
Exactly. What fundamental shifts in consumer behavior, perhaps, or what technological breakthroughs just beyond the immediate horizon might not yet be fully priced into even these exciting growth companies? This could represent an even deeper, unappreciated long-term opportunity for those willing to look further out. Or perhaps it could represent an unseen disruptive risk that few are discussing right now, focused as they are on the next data point.
That's a great provocative thought to end on. It really raises an important question for you, our dedicated listener. As you consider all these insights, this current market landscape, the growth themes, the analytical tools we've shared, what stands out most to you? How might you apply this analytical framework, this structured thinking, to the companies you're interested in, to ensure you're not just riding the wave, but truly understanding its powerful currents and navigating them skillfully for your own goals?
Keep digging deeper.
Absolutely. We encourage you to continue your own deep dives, always question assumptions, both bullish and bearish, and always strive to make truly informed decisions based on solid analysis, not just sentiment.